Hello everyone, we are group IR1 which have me, Valencia Francisca, and my friends Jennifer Clarissa Liano that will explain about Psak 233, which is about earning per share or EPS, which is really important because it will determine will the investor buy or sell the shares. So without further ado, let's get started to the materials. So, what is earning per share or EPS? It tells us how much a profit a company makes for each ordinary share. It is important because it helps investors see how much money they could earn for each share they own. The formula to calculate EPS is net profit for ordinary shareholders divided by the weighted average number of shares or WANOs during the period. If EPS is high, it means it shares during period earning more profit. But it also means if EPS is low, it means a share is earning lower profit. So companies with higher EPS are often seen as more successful and attractive to investors. So for this Psak 233 must be used by companies that have shares traded publicly or plan to offer shares to the public. It covers both separate financial statement and group, or we call it consolidated financial statement. However, when both are presented, EPS only needs to be shown in the consolidated financial statement. This ensures that investors get a clear and complete view at the group levels. So, next, we will learn about the key definition or important words that we need to be familiar or know before moving, which is ordinary share. Ordinary share is the basic kind of share with rights to company profits after other shareholder. Next is the potential ordinary share, which is something like an option or convertible bond that can become an ordinary share. And there's dilution, which is happens when EPS goes down because more shares might be added. Next, there are options and warrants. It's like a special rights to buy shares later. And there is contingently issuable shares, which is shares that are given only if certain conditions are met. And the last one is anti-dilution, which happens when EPS goes up or loss per share goes down. Next, it is about basic EPS. Basic EPS is calculated using profit available for ordinary shareholders divided by weighted average number of ordinary shares during the period. We first adjust profit by taking away dividend that must be paid to preference shareholders. The average number of shares reflects how shares change during the year, giving a fair result. Basic EPS shows how much profit its shares earn without considering future share changes. And next, we will learn about preference shares and also their effects. Preference shares can affect the profit available for ordinary shareholders if preference shares are non-cumulative. We only subtract the dividend if they are officially declared. If they are cumulative, we must subtract the expected dividends even if not declared yet. If a company buys back preference shares or changes their terms, any extra cost is taken out of profit for EPS calculation. So now we will learn about weighted average shares. We use the average number of ordinary shares during the year, adjusted for any changes like new shares issued or shares bought back, which is a treasury share. This is important because companies may issue shares at different times during the year. We count shares only from the date when the company actually received payments or service in return. Next is learn about special consideration for share inclusion and also adjustment for capital events. So, some shares need special treatments. Shares from business acquisitions are counted from acquisition date. Shares that must be converted into ordinary shares are counted from the contract date. Shares that depend on meeting conditions are only counted if all conditions are met. Shares that might be taken by the company are excluded until they become fully owned. And sometimes companies change their shares without getting more money, like giving bonus shares or splitting the shares. In these cases, EPS must be adjusted for all period shows, even for past years, to make comparisons fair. So EPS must be adjusted for all period shows. So right issues with bonus elements and reverse split are also need adjustment. Next, we will learn about dilutive or diluted EPS. Diluted EPS shows what earning per share would look like if all possible new shares were created. This includes shares options or convertible bonds or other contracts. It gives investors more careful view of how their earnings might be diluted in the future if shares are issued. So when to include dilutive shares, we only include potential shares if they would make EPS lower or make loss per share higher. We use profit from the continuing operation to check if shares are dilutive. Each potential share type must be checked separately, starting the one that caused the biggest dilution. Next is the dilutive potential shares. Potential shares are dilutive if they lower EPS. If they would increase EPS, they are anti-dilutive and are not included in the diluted EPS. We check each type of instrument that will create most dilution, or like we can take an example of options and warrant because they can add shares without changing the profit. Next is will be explained by my friend Jennifer Clarisalian.
Okay, so next we're gonna discuss about the options, warrants, and their equivalent. So, in the financial reporting, options, warrants are financial instruments that give the holder the right to buy shares at a set price before a specific date. So, in the EPS calculation, these instruments are potentially shares. So, if it's dilutive, they increase the number of shares for diluted EPS, which can lower the earnings per share. So for the diluted EPS, the entity assumes dilutive options and warrants are exercised, meaning that the company gets cash from the exercise, and we calculate how many shares could be bought back at the average market price. So the difference between shares issued and share repurchasable at average market price is treated as an issue of shares for no consideration or dilutive effect. So they're dilutive only when the exercise price is lower than the average market price. So for the dilution amount is calculated as average market price minus the issue price. Okay, so for diluted EPS, potentially ordinary shares are divided into two parts. The first one is share issued at market price, so it's considered fairly priced, so it's not dilutive. So we exclude from the calculation. And the second one is share issued for no consideration, or we can call it as free shares. So we consider that as dilutive, so they are added to the number of outstanding shares in the diluted EPS. Next one is convertible instruments. Convertible preference shares are anti-dilutive if the dividend per share on conversions exceed basic EPS. So this means if after conversion, the dividend per share is higher than the current earnings per share, it would lower the EPS. So we don't include it in the diluted EPS because it's anti-dilutive. Second one is convertible debt is anti-dilutive if the interest after tax per converted share exceed basic EPS. This is the same as previous, so if converting the debt causes more interest expense than the basic EPS, it can reduce the EPS, so it's not included in the diluted EPS. So, third one is if only some convertible preference share are redeemed or converted, any excess consideration is allocated only to the redeemed or converted shares. So, if the company paid more than the face value, the extra is just for the shares that were converted. These are assessed separately from shares that remain outstanding to determine dilutive impact. So we check the dilutive effect of the converted share on their own, so it's not mixed with the ones that is still outstanding. Next one is the contingently issuable shares. Contingently issuable shares are shares that a company may issue in the future, but only if certain conditions are met. For example, like the performance target, like revenue goals or earning goals, and so on. If the conditions are met at the end of the period, shares are treated as outstanding from the beginning of the period. If the conditions are not met, use the number of shares that would be issued if the period had ended at the reporting date. So, if the conditions are met, this can maximize the potential dilution. But if the conditions are not met, this can give like a what if view. Restatement is not permitted if the conditions are not met when the contingency period expires. So once the period ends and the conditions were met, we can't go back and adjust the EPS later, even if the conditions are met after the period ends. Contingently issuable potential ordinary shares are included in diluted earnings per shares by first one evaluating whether the shares can be assumed to be issued based on the contingent conditions, and if those potential ordinary shares should be reflected in diluted earnings per share, calculate the impact using the method for options and warrants, convertible instruments, or cash or share settlement contracts. Next one is contracts that may be settled in ordinary shares or cash. If a contract can be settled in shares or cash at the entity's option, assume a settlement in shares. Include in diluted EPS if dilutive. Second one is if the contract is accounted for as an asset or liability, adjust the profit or loss as if it were pure equity. So if the contract is recorded as financial asset or liability, adjust the profit or loss to reflect it as if it was equity. So this can make the EPS calculation more consistent. If settlement is at the holder's option, use the method cash or shares that results in greater dilution. If the holder decides how to settle between cash or shares, always assume the option that causes more dilution. So basically, it's usually shares. It can lower the EPS. We have an example right here. The first one is a debt where the entity can choose to repay with cash or shares. And then the second example is a put option that allows the holder to demand cash or shares. Next one is purchased option. So what is a purchase option? A purchase option are contracts that give the holder the right to buy or sell something at a specific price before a set date. There are two types of purchased options. The first one is the call options. This lets you buy an asset, like shares at a certain price. This can make money if the market price goes higher than the set price. Second one is the put options. So this can let you sell an asset at a certain price. This can make money if the market price goes lower than the set price. So purchase, put, or call options. These are not included in diluted EPS because they are anti-dilutive. Why are they anti-dilutive? So first one, put options. Put options is only exercised when the exercise price is bigger than the market price, meaning the company buys back its shares at a higher price, so there are no dilution. And the call options are exercised only when the exercise price is lower than the market price, meaning the company buys shares more cheap than the previously, so still there is no dilution impact. So since they don't reduce the EPS, they are excluded from the diluted EPS calculation. Okay, so next one is written put option. So written put options are like contracts where the company is required to buy back its own shares. So if these contracts are in the money, meaning the settlement price is higher than the average market price, they can have a dilutive effect on diluted EPS. So in the money means the contract is beneficial to the holder. And in this case, for written put options, if the settlement price is higher than the average market price, the company will need to repurchase its shares at a price higher than the current market value, which can potentially leading to dilution. So, how to calculate diluted EPS in this scenario? First, we assuming new shares are issued at average market price to raise funds. Second one is using the proceeds to repurchase shares per the contract. And then the last one is including the difference, which we minus the issued shares minus the repurchased shares as incremental shares in diluted EPS. Next one is retrospective adjustment. So retrospective adjustment, it means that going back and adjusting past financial data as if a change had already happened in the past. This can to make the numbers consistent and comparable. Next one is retrospective adjustment. It means going back and adjusting past financial data as if a change had already happened in the past. So this can make the numbers more consistent and comparable. So if the number of ordinary or potential shares increases or decreases, basic and diluted EPS for all periods presented must be adjusted retrospectively. If these changes happen after the reporting period but before the financial statements are authorized, EPS must still be calculated based on the new numbers of shares. So, for example, like bonus shares, stock splits, or reverse splits, and etc. Disclosure is required to inform that EPS reflects on the new share count, like I mentioned before, whether maybe there is a bonus share or stock splits or reverse splits. However, EPS is not restated for changes in assumption or for actual conversion of potential shares. So there are no retrospective adjustment if the change is from the new assumption or the actual conversion of potential shares. For example, like convertible debt being turned into shares. Okay, next we're gonna talk about the presentation of EPS. So EPS must be presented clearly in the statement of comprehensive income for profit or loss from continuing operations and total profit or loss attributable to ordinary shareholders. Okay, so EPS must be shown equally and clearly for all periods presented, including the prior periods. If diluted EPS is reported for any period, it must be shown for all periods, even if it's the same as basic EPS. If items or profit or loss are presented in the separate statement, EPS should also be shown there. And for discontinued operation, disclose EPS, both basic and diluted, either in the income statement or in the notes. And finally, remember to always show EPS even if it's negative. Is meaning is like representing a loss per share. Okay, so next we're gonna discuss about disclosure. Disclosure in financial reporting refers to the process of providing detailed and transparent information about the financial aspect of an entity in its financial statement or accompanying notes. This is done to give the users of financial statement, like investors, analysts, or auditors, a more clear understanding of the entity's financial position, performance, and the accounting methods used. So there are numerator disclosure. So this report amounts used in calculating both basic and diluted EPS. And then numerator disclosure can reconcile this amount of profit or loss attributable to the parent, showing how each class of instrument, like convertible bonds or options, impact the calculation. Next is the denominator disclosure. So in the denominator disclosure, it can report the weighted average number of shares used in calculating both basic and diluted EPS. And then for the denominator disclosure, can provide a reconciliation of these denominators, which is showing how each class of instruments affect the number of shares. Then there are anti-dilutive instruments. So this disclose instruments that could potentially dilute EPS in the future. And then if they are anti-dilutive for the current period, meaning they wouldn't reduce the EPS, they should be excluded from the diluted EPS calculation. However, they should still be disclosed. And then there are post-reporting share transactions. So in the post-reporting share transactions, we can describe share transactions or potentially transactions that could significantly change the number of shares outstanding if they had occurred before the reporting period. So this includes things like issuance of share, redemption of shares, or exercise of options that could have affected the number of shares using in the EPS calculation. Okay, so next one for the disclosure is if an entity reports additional per share amounts based on the component from the statement of comprehensive income other than what's required by the standard, these amounts should be calculated using the weighted average number of shares as per the standard. Basic and diluted per share amounts for the component should be disclosed with equal prominence and included in the notes. The entity must clarify the basis used for determining the numerators, including whether the amounts are before or after text. And the last one is if the component used is not reported as a line item in the statement, a reconciliation must be provided between that component and a reported line item in the statement of comprehensive income. Okay, so that's all for our presentation and explanation about the APS. Thank you for listening.